Hi, James. Can you hear me?
I can, yeah.
Amazing.
Uh,
Right.
we should now have video.
Yeah. Okay. Right. Bye, Eamon. Ciao. Right. It's just you and me, kid.
I've just got to launch YouTube. Hang on.
Hang on. I've already done that.
No, I've got to do it
Have you?
as well. Yeah.
Oh, right. Okay.
Yeah, otherwise I can't see the questions.
Oh, right. Sorry. Yeah. 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 Okay. I've got your slides here as a backup if need be.
Um, could Janus have the same problem getting in or not?
You shouldn't
Michael
have.
Hart's just started a Teams meeting.
Okay. Well, look, I mean, I will put myself on mute again. Um, all right. Gonna mute. All right. Okay. Right. I think you're viewing James Carthew's screen. I think the one that bothers me ever so slightly is that the controls that I've got for Zoom seem to have disappeared. But why is that? They've like disappeared off the bottom of the page, but oh well, I don't think it's going to matter. Anyway, deal with it. Deal with it when it becomes a problem.
Morning, Janus.
Hello?
Yes, I can hear you. I
Hello?
think. Yeah. Can you hear me?
Hello?
Yeah, I can hear you saying hello. Yeah. Is that all right?
Can you hear me?
I can, yes. Yes.
I need to move to my AirPods so that it's better in sound.
Okay.
I, I thought it was connected. Give me a sec. We don't use Zoom very much. Is it better now?
Yeah, that's good.
Oh, great.
Brilliant. Cool.
Morning, James.
So, news-wise, it's just me. I've got one story. Richard's got another one. So, so after Richard, we'll be talking to you. But I should think it'd be quite quick, I think, this morning. So,
Okay.
if you don't mind going
So,
on mute until then, that'd be perfect. Thank you.
the what? Sorry?
You put yourself back on mute till we're ready for you, please. That'd be
Sure.
yeah,
Sure.
fantastic.
Thank you, James.
Okay, talk to you later. Okay, let's get going. It's 11 o'clock. So I've got a bit of news to look at. So is Richard. So we'll do that first, and then I'll be talking to Jean-Hugues de Lamaze, who is the manager of Ecofin Global Utilities and Infrastructure. So news-wise, the obvious one is hypnosis. So that's the one I'm going to cover. And then I said Richard's going to do Balanced Commercial Property Trust. So we know the story. We've been looking at this for months, years now. NAV marched all the way up. Newport comes in, massive great write down with the shot tower thing. That's all backdated in Morningstar. That is not actually when it happened in real life. And then, well, actually, when that was announced, there was a bit of a jump in the price, and we were all like, okay. And then now we've got the bid, and it's a long way north of where the share price was, but not quite as good as previous levels. Obviously, that's only taking us back to where we were back in 2022. So that an awful lot of people lost an awful lot of money on this. So the cash offer is $1.16 a share, which works out about 93.2p. There is a chance, they sort of put this in the documents, that there'll be another 2 cents if the manager waives its fee under the termination agreement. I cannot understand why it would do that. I don't see why it would feel it would needs to be generous, but there we go. It's not a bad price, really. I suppose it's a big premium, obviously, to the share price, which is helpful. It's a premium to the latest NAV, but that NAV is an awful long way down, as we've said, from where it was before. What they said was they had a number of approaches, including a number of approaches from the bidder, and this was the highest of those on the table. So the buyer, Alchemy Copyrights, which is Concord, are the same people that bought Roundhill Music. And the coincidence here, which is probably not a coincidence, is that Rob Naylor, who's the chair of Hypnosis Songs Funds now, was the chair of Roundhill before he got sold. So he dealt with them when he was doing the disposal of Roundhill. And so presumably knows them well. The backer of this is Apollo. So they're putting some equity and a lot of debt, I think, behind this acquisition. Concord says it's already the world's leading independent music company. It's got about 1.2 billion songs. Obviously, this will make it that much bigger. The wrinkle in the whole thing potentially is the call option that the manager has over the portfolio. So basically, if it gets terminated in this circumstance of a bid, then it has the option to buy the portfolio at the higher of the market cap and the NAV and the price being paid by the bidder. So if they don't have the money to do that themselves, presumably it's possible that Blackstone will put the money up if they wanted to put more money into songs. Don't know if that's true or not. It wouldn't be great news for shareholders, because I would think that in that kind of circumstance, they probably just match the bid rather than surpassing it. And the Concord lot will probably want some or all of the £20 million that the board has agreed to make available to a failed bidder to encourage these bids in the first place. So that would take about 1.65p off the price, the exit price for shareholders. So it does look like, barring interference by the manager, that it's going to go through. There's quite a lot of sign-ups here from various fund managers, altogether just shy of the kind of limit of where they could have gone to without forming concert party and bid for it themselves. So yeah, this is quite a big tick in the box. This is the share register from Bloomberg. Now, these things are never perfect because they're just taking what's come. They can scrape from various announcements of the company, and that's just by the individual managers. There's no mention here of Madison and Gresham House, who are about 1.54, 1.37 according to the documents. The funny thing is the Marshall Waste one, so they've got quite a big short on. And I did check that was still on the 16th of April, so it doesn't look like they've lost money on this. Shorting things that might get bid for is always a dangerous thing to do. There we go. What I thought looking at this list there's no obvious party in there that's going to think, oh no, this isn't the deal that I wanted. Let's do something else. So while it's possible that another bidder might come over the horizon at a higher price, um, it it looks like otherwise this is going to be a done deal. So the structure of the deal is slightly complicated because it's a court-sanctioned scheme of arrangement rather than a normal bid. It needs 75% of the people voting to vote in favour of it. As we just said, I think that's probably likely. Then it gets rubber stamped by a court. So they're going to put out a document within 28 days. I think we'll see how long it takes. But they're saying the meeting's probably going to be on the 10th of June. And it will stop trading the day before that. The price has come up. It was sort of 92p versus the 93.2 level. So there's not a lot of wiggle room into trading much ahead of that anyway, but we'll see what happens. If all of that gets done, they say it's effective in Q3 2024. Really, there won't be much of a time gap beyond getting the whole thing signed off and the thing going through, I think. If for whatever reason this whole process is frustrated, then the bidders reserve the right to make this a more straightforward takeover offer, which has different kind of rules. So that's enough from me. Let's hand over to Richard.
Thanks, James. Yes, so this week we had another property company potentially raising the white flag. This time, Balance Commercial Property Trust. So we all know the story with property over the last 18 months, 2 years. There's its chart. So its NAV's obviously come down massively since interest rates rose. Value of its property fell, NAV fell. But they have been doing the discount has been coming in the last sort of 6 months. It's now trading at about 28% discount. And they've if we look on the next slide, this is their market cap ranked of the UK commercial sector, and they're the second largest in market cap of the diversified funds, behind UK Commercial Property REIT, which is likely to be going to merging with Tritax Big Box. So as I'll come on to later, I think this would be quite a shame to lose this trust. We'll go on to the next slide. We look a bit into the announcement. So they said all options are on the table. They've obviously become frustrated about the persistently wide discount and the near-term economic and sort of property market outlook. So they've said what could happen is they could sell the portfolio, the company could be sold, there could be another merger with another trust, or a managed wind down, or it could continue with some form of discount management, or they could even sort of change the manager or even change the investment strategy. An outcome will this is ahead of a continuation vote, which is to be held this year, and so they'll have an outcome before that vote. And this slide is ranked by the 5-year NAV return in that section. You can see it's pretty disappointing. Only Regional REIT has really got worse than it over that period and over most periods really. And this is because of its, I believe, its portfolio composition. It was very heavily weighted towards the office sector, which we all know has had its sort of challenges, and was a bit slow to react to those and sell off those. So we look on the next slide, we can see a bit more of its portfolio. So it's massively dominated by St Christopher's Place in London, which is valued at over 200 million. So it's more than 20% of its portfolio. And as I said, it has been rebalancing its portfolio away from offices now. So in 2020, it was about over 40%. It's now about just over 20%. But it's been quite slow to do that. And so 4 of those sales have been held this year at a 2.6% discount to their latest value. And the largest one was done in February of its largest office asset. And that was at a 6% discount. So you can see by waiting or delaying this decision to sort of move away from offices, it's not getting the best price, and it's even discounted from values which have already been discounted before that. So I think that's had a big impact on its performance over the last few years. On to the next slide. This is its portfolio now. These are sort of rough weightings, obviously, because they've sold recently, but you see offices come down and industrial now sort of come up. That's a big difference to a few years ago. But like I said, it all seems a bit sort of too late, sort of reactionary, behind the curve. And this is another thing to consider, is that it on its debt side, it's got a £260 million loan with LNG, which expires at the end of this year. They've brought in new facilities that will refinance that when that expires, but will be a massively high costs, which will obviously impact on their earnings next year. LTV's decent, low level, which is good, but like I said, so they upped their dividend last year. It's now paying 5.28p a year, which is mostly covered with earnings at the moment, but that's obviously going to come under pressure next year with the high cost debt facilities, depending on how they get away these or the sales proceeds and things like that. But yeah, but I think it would be a shame to lose these if they do go that way, because it's, as we saw in one of the earlier slides, they're now, if UK commercial goes, they'll be the biggest fund doing what they do, like diversified REIT. And I just think it's a missed opportunity. They could sort of solidify that position. That may be the way they go. They sort of maybe merge with a couple of the other trusts doing the same thing and become sort of dominant in that sector. And that's the way I think hopefully it does go. But we shall see.
Do you think it might make sense for Shaftesbury to look at it, given St Christopher's price thing?
Yeah, it could be, but there's obviously that one asset which is 200 odd million, and then there's a big sort of tail there that they'll need to sort of get rid of. So they're sort of specialist focused in London's West End. So I mean, they could table an offer for St Christopher's Place, I suppose.
Yeah, possible. Okay, thanks very much.
Thank you.
Now let's talk to Jean-Hugues. Good morning.
Yes, good morning, James.
Thank you very much for doing this again. I think it's last February we did it, but obviously been plenty of developments in the sector since then. But nevertheless, even though you done it before, can I just ask you, as usual, just to sort of introduce the fund a bit first, please, and then we'll come to some questions.
Sure. Ecofin Global Utilities and Infrastructure Trust. This is a trust which we launched in 2016 out of a strategy which Ecofin has been running for over 15 years in different formats. Ecofin is, for those of you who don't know us, is a specialist of infrastructure and the energy transition. The name originally, when the firm was founded over 30 years ago, used to stand for Ecology and Finance. And frankly, we haven't changed the focus. We are investment specialists. We define ourselves as a sustainable investment firm, and we very much invest in listed equities in the utilities and infrastructure space worldwide. So that's a brief intro. What I suggest in the next sort of 20 minutes or so is to run through the strategy through three different aspects. I will obviously introduce an overview of the trust and the strategy. I will also describe how we see the current investment opportunity to invest in global infrastructure as pretty historic. And I'll finish with some elements of valuation. So first of all, an overview of the strategy. I'll start with performance. As you can see, since we last spoke in February last year, it's been quite challenging for infrastructure and utilities worldwide. I would say the main factor to blame is really the evolution of interest rates, particularly in the US, the steepening yield curve in the US, the gradual increase in the US 10-year Treasury yields has been a very serious headwind to long duration business models as the ones we have in infrastructure and utilities specifically. And actually in the last quarter of 2023 calendar year, when we saw somewhat of a mean reversion in US 10 years, performance dramatically increased very quickly. But overall, let's say the past 12 months have been very challenging. The month of March 2024, much better, as you can see on this slide. And probably the point to highlight is that over the long run, despite the challenging last 12 months, the strategy delivers its objectives. Over the past 5 years, the NAV and the share price have increased by roughly 55%. And since admission of the shares in 2016, the trust has delivered around 9% NAV increase per annum and around, close to 10% share price increase per annum, which is, in terms of total return, pretty much twice the return delivered by the sector indices or the FTSE. So that's very much the objective, to stick to those long-term resilient type of annual returns. Strategy overview. It's a global strategy, as I mentioned, exclusively investing in listed equities. We aim at keeping sort of a balance between North America and Pan-Europe. So UK, Europe. We've capped the exposure to emerging markets at 10%. That's mostly for risk purposes, plenty of opportunities in emerging markets, but to be honest, our strategy is largely driven by the opportunities that we see in OECD markets. And then the strategy aims at delivering a combination of income and growth. Income, portfolio yield around 4%. And growth, and that's a bit less intuitive when you think utilities in particular. Growth is actually much more sustained than a lot of people or generalist investors may have in mind. We estimate that dividends are here to grow by 5 to 7% per annum over the medium term. That's very much the type of profile we have in our portfolio. And that's a structural trend. Very hardly cyclical, very structural, and we believe largely related to the energy transition phenomenon, which I will describe in a minute. So that's for the very broad overview. Target total return 6 to 12% per annum. I just mentioned the achieved total return since inception. And I'll finish on that slide by just reminding you of the investment universe. It's a reasonably strict definition of infrastructure through electric and gas utilities, first segment, with a growing proportion of renewable energy in there. Then environmental services, this is water, waste management in particular. And finally, transportation infrastructure, toll roads, airport services companies. So as you can see, all of those companies in this universe are service companies. And actually, the next slide gives you the main characteristics of the business models that we aim at identifying. All the companies in our filtered universe and portfolio are asset-backed services based on long-term contracts. We want those long-term contracts to provide high degrees of predictability of the future cash flows, and we want the predictable cash flows to ensure sustainable and growing dividends. So those would be the three main characteristics which you will find in common to all the names and subsegments in our portfolio. Moving on to the next slide, we present in here what we see as a major structural opportunity. to invest in global infrastructure. The space, and particularly the utilities portion of infrastructure, is going through a dramatic transformation on the back of the energy transition. As you can see on the bar chart at the top of the slide, 10, 15 years ago, about half of operating profits of typical utilities was stemming from conventional power generation, which was largely a commodity-driven business. So volatile type of business model. Today, this proportion has shrunk to about 10% only, while 80% of a typical large utility nowadays, particularly in Europe, UK, 80% of operating profits from large utilities are actually fully contracted and give you high levels of predictability of the pricing. So this is a combination of regulated models, typically in networks, or fully contracted long-term service contracts, which we typically see in the renewables, large renewable contracts. So 80% of the cash flows of utilities are now very much contracted and predictable. This means overall exposure to stronger growth because renewables are a strong growth industry. You are all familiar with that, but we'll give you a couple of data points in the next few slides. It also generates typically exposure to higher returns, and it's a dramatic de-risking of the business models compared to the situation of utilities 10, 15 years ago. That's a structural evolution which is well engaged in UK, Europe. We estimate that about 30% of the EBITDA of Europe's 10 largest utilities derive from renewables. And it's only still less than 10% in the US, which is the situation where Europe was 8-10 years ago. So it's moving fast. It's structural evolution. Some countries are going much faster than others. And I like to mention the example of the UK, which 15 years ago was still generating half of its electricity out of coal, and coal power generation now represents less than 1% of total power generation in the UK. So a dramatic transformation in less than 15 years. In the next slide, we illustrate what I just mentioned, i.e. an exposure to structural growth, which we find extremely attractive, compelling. On the left-hand side, you see some figures which most of you would be familiar with, how the investment in renewable electricity's capacity is massive worldwide. This is a global statistic. Most consultants would tell you that estimates are that investment in renewable electricity capacity will represent about twice the gigawatt capacity over the next 5 years compared to the past 5 years, so a doubling of capacity investments. This is very much the result of the dramatic political commitment to the Paris agreements, to the decarbonization of the planet by 2050, for more than 90% of the global GDP. Even China is actually committed to decarbonizing its economy by 2060, which is only 10 years behind the Western countries. So that's a significant evolution. And look on the right-hand side, what CapEx acceleration means for share prices and valuations. Typically in our space, we've taken the example of Terna, Italian power network company. You see the blue bars represent the evolution of Terna's CapEx budget. And as you can see, there's quite a strong correlation with the evolution of its share price. Interestingly, Terna announced a few weeks ago a massive acceleration of its CapEx program for Italy in the next 5 years, which came about 60% above market expectations. So that gives you an idea of how fast the CapEx budgets are being increased for networks in general, and notably to adapt to the development of renewable and electricity. about twice the budget for Italy in general or Germany in the next 5 years compared to the past 5 years. So sustained growth. And more recently, we've heard about, you've all read in the press about some accelerating factor for demand of electricity related to data centers. At the top of this slide, you see how we expect electricity demand to evolve and grow in the next few years in the US. It's quite a tangible acceleration by the end of the decade, related to development of electric vehicles, data centers, reshoring. That's partly an implication of the IRA program, massive investment program in the US. But I think it's worth spending a minute on what's going on with data centers. Amazon actually signed an interesting contract earlier this year with a US utility to provide baseload electricity. And the estimates are that in the next few years, you're going to see a massive acceleration, about 5 times the typical power demand from AI data centers, particularly in the US, but actually it's bound to be a global phenomenon. And look at what happens to those companies which are positioned to potentially benefit from this phenomenon. Because they provide baseload power supplies. We've taken 2 examples here, which are the most relevant, I believe, on the right-hand side of the slide: Constellation and Vistra. So 2 US utility, traditional US utilities, partly exposed to nuclear. Constellation is a nuclear specialist. Vistra has a mix of baseload power generation. And you may be interested to see how their share prices have performed year to date, plus 80% for Vistra. And that is purely on the back of those contracts related to data centers. By the way, these are 2 holdings in our portfolio. Constellation is a top 10 holding for the trust, and Vistra is also among the top 15 holdings in our portfolio worldwide. So obviously, we're benefiting from that exposure. So another illustration of the growth drivers, structural growth drivers that we see emerging and developing in our investment universe. So that's about growth. But obviously, beyond growth, you need returns. And there's been some questioning of particularly the sustainability of the returns in the renewable energy industry. Well, those charts, which are data statistics for US and Europe provided by Level 10 Energy, which is an independent data provider. And it's quite interesting, I find, because that gives you an idea of how the power purchase agreement prices have been evolving over the past few years, both in US, Europe. And as you can see, there's been a much stronger ability than expected, probably, to pass through the effects of inflation and to increase prices of those large renewable energy, wind and solar contracts. In the US, we're close to the peaks. In Europe, also with somewhat of a stabilization over the past few months. This data is actually as at the end of 2023. But we find it quite interesting that the space has been able to increase its pricing for the large contracts, which are very much those that we invest in through our portfolio of your investment trust. So we think this type of data bodes very well for the future, and also comes in contradiction with the perception that renewable returns may be under pressure because of the difficulty to pass through the effect of inflation of costs. Well, this is very much denied by this type of statistic. And the next page goes further down into that topic. Look at what happens to earnings space in the current context. Quite interesting, and maybe a bit counterintuitive again, that over the past 12 months, despite also over the recent months some declines in power prices. I'll mention maybe in a few minutes that there's been a bounce back over the past few weeks. It's interesting that earnings outlook for utilities worldwide has only improved. So at a time when utilities have been very much challenged on the stock market, there's a major discrepancy between the performance of a lot of those names over the past 12 months, again, very much on the back of evolution of interest rates, and the reality of the profitability and earnings outlook for those companies. The chart on the left-hand side is actually how earnings expectations have evolved over the past 12 months. And they are roughly today about 6% higher than what 5 or 6% higher than where they were a year ago. So analysts have been raising their estimates, and companies have been raising their guidance, both in Europe and the US, in an environment which is perceived by listed equities markets as challenging. Well, this is again a contradiction of that. And on the right-hand side, you see how we expect US utilities to be able to accelerate their EPS growth per annum over the next few years, from a typical about 3% compound annual growth rate to about 9%. So it's a massive acceleration of the top line, but also the bottom line for the space. And now I get to the last part of this brief presentation before we open to Q&A, of course, and it's about valuation. So I mentioned how challenged the space has been in listed equities markets over the past 12 months, and look at what it means in terms of relative valuations of the space. We are close to historic lows in terms of relative PEs for European utilities, US utilities, infrastructure in general. Those levels are quite striking to me, especially in the context of fundamentals, which we only see strengthening rather than deteriorating from what we can see in our portfolio. And with EGL, so the trust, you also have a portfolio which we believe is well positioned, which is actually cheaper, much cheaper than the general equities market, but also actually quite cheaper than the typical infrastructure or utility sectors. You see that at the bottom end, right bottom end of the slide. One year forward EV EBITDA of 8.5 times, PE of about 11.7 times, when typically global infrastructure are trading on around 15 times, and a dividend yield of close to 5% for the portfolio, the current portfolio. So we think we are extremely well positioned as of today to actually benefit from a possible, we think likely, revaluation of the space from the current historic low levels of relative valuations that we see in the markets. And there is an additional factor which could at some point become dominant, which is actually the activity that we see in private equity markets. Infrastructure worldwide is largely driven by private equity. We invest in the listed part of it, but it's interesting, obviously, to see the valuation gap, significant valuation gap between those two worlds of private versus listed. What we've seen over the past 2-3 years is that the premium that private equity investors have been paying for listed infrastructure assets has actually increased. So it seems that private equity investors tend to be much more optimistic about the long-term perspectives of infrastructure and utilities worldwide than typically listed investors, who tend to be maybe shorter term, as we all know. And we are starting to see some consolidation. We've seen massive consolidation, for example, in a market like Australia, where you had 3 major companies taken out in the past couple of years, and a few takeover bid attempts as well in Australia. And we actually, more recently, Encavis, a German renewable energy developer, was taken out by KKR, more than 50% premium to the last share price. And interestingly, we see, and you all know that, that the major private equity players in the world, in the infrastructure world, have been raising massive tens of billions of dollars over the past 3 months even. And we've listed some of those. BlackRock, Macquarie, Brookfield, KKR have all raised new funds and have had cash inflows to invest in the infrastructure world globally. And we think actually this is potentially a major factor to drive the revaluation of the space, which we very much believe in. The next page is actually a further illustration of that phenomenon. We've listed here the main transactions in the global airports world. And a few days ago, there was a new transaction announced by Vinci, the French concession operator, which took 50% of the Edinburgh airport. And it's interesting to see that the typical valuation multiples that we see in airport transactions worldwide, but so in the private market, are around 20 times EV/EBITDA when listed airports trade on hardly 10 times. So about twice the multiple applied by private equity operators for the same airports than those which are listed, which are trading at a massive discount. This is only one further illustration of the phenomenon I just described, which is actually common to the whole global infrastructure space from our perspective. So that pretty much concludes what I wanted to explain and present. On this slide here on the screen, you have the main holdings of our portfolio. As you can see, there's a good dispersion of geographies and sub-segment exposure. We have a combination of regulated and less regulated business models. And we very much pay attention to that diversification of the portfolio so that we don't have excessive exposure to one single regulatory framework or one single type of business models. And this is what gives us confidence in our ability to generate the total return objective of 6 to 12% per annum with a portfolio yield of currently close to 5%.
That's
so
great.
Up to you, James. Yeah.
Yeah, that's cool. It's interesting what you're saying about data centers, because there was a story yesterday that Greencoat Renewables just sold the output for one of its Irish wind farms entirely through a PPA to the Keppel Data Center REIT. Just
Exactly.
Yeah.
Are we going to see more and more of those examples? It's all happening, and it is a massive transformation and accelerator for the space. Yeah, very interesting.
Cool, thank you. So let's a few questions about sort of the structure and how you run the fund first, if you don't mind. So first, how do you think about risk, and how do you manage that, and how do you ensure its properties are diversified and everything else?
Yes. It's obviously a key factor. So we have within our team, we have 2 risk managers, by the way, who pay attention to on a weekly basis, pretty much daily basis, but they give us weekly reports on the risk exposure. We pay a lot of attention to, I would say, 2 factors in particular, among others. The first one is very much to diversify exposure, as I mentioned, to different regulatory frameworks. When you invest in utilities, you are always subject to some kind of bad surprise from a regulator suddenly hitting the returns or political intervention. And we have that. We know we have that. We try to prevent it, obviously, by doing a deep fundamental micro-analysis of the space, but sometimes you have bad surprises. Well, by diversifying your portfolio by geographies, in the US, the regulatory framework in Texas is going to be very different from the one in Connecticut, and in Europe, Portugal is very different from Spain, for example. So geographical diversification is critical. There's another factor which we pay a lot of attention to. It's the beta profile of the names we invest in. Typically, if you invest in, let's say, a purely regulated utility in the UK, you're going to have a beta versus the MSCI index of about 0.3, 0.4. Now, if you invest in an airport, the beta is going to be closer to 1. So we pay a lot of attention to the average beta of our portfolio, and typically we want it to be around 0.7, 0.75. That's where we believe our investors are, positioned in a fairly defensive way, but also with exposure to the structural growth profiles and thematics that I referred to. So probably those two elements are the key to our risk management in the portfolio.
Can you say a little bit about Asian emerging markets and whether you see opportunities there, or whether it's just you're convinced you just want to keep it to OECD, please?
So we have some exposure to Asia. As I mentioned up front, we want to limit exposure to emerging markets because those markets are much more volatile. In terms of risk exposure, obviously, it would be a massive change to the risk profile of the trust were we to lift that 10% cap. So we very much stick to it, and we've been extremely reluctant to investing in emerging markets over the past couple of years. One example is what's happening in China. Maybe we could illustrate this with a chart, which I think you have in the appendix, James. I don't know whether you can point to the appendix. On mine is page 21. And that's an example of Longyan, China Longyan, which is one of the largest renewable wind developers actually in China. And we've put here two charts of the same, two share price charts of the same company. The green line at the top is China Longyan listed on the domestic Chinese market. The blue line is China Longyan listed on the Hong Kong international share market. And as you can see, the first one is pretty much flat in the past 12 months. The second one is down 50%. That gives you an idea of the difficulty to invest in those markets. There's been massive outflows out of the international equity market in China. So we see really attractive investment opportunities in the Chinese market. We see massive sources of growth, stocks which are trading at some of the lowest multiples you can find worldwide. But despite that, we want to cap exposure there. It's currently, I think, our exposure to China is, I think, hardly 6% for the total portfolio, due to those phenomena, which are flows phenomena, which are very difficult, obviously, to control. So yes, great opportunities, but much more volatile and riskier than the rest of our portfolio.
Great, thank you. Obviously, you do have some foreign currency exposure. How do you manage that?
So typically, by talking to investors over the years, our shareholders have asked us not to try to hedge currency exposure. Obviously, we are a UK stocks trading on the London Stock Exchange, so very much a sterling product. And 85 to 90% of our portfolio is outside the UK. So yes, we have international currency exposure, but we provide a pretty clear description of our geographical exposure and currency exposure on a monthly basis. We don't change it dramatically. And while we have in our status the facility to hedge our currency exposure in some exceptional circumstances, we've done it in a couple of occasions in the past, very special occasions, notably when there's a big election coming up, those kind of situations. But typically, we don't hedge currencies. We provide the geographical and currency exposure.
Great, thank you. There's a couple of questions about sort of ESG type stuff. So firstly, how do you factor ESG into investment decisions when you're doing them in the first place? And then secondly, do you kind of engage with the management of the companies at all? And can you give us an example of maybe you've done that?
Sure. So ESG, of course, it's part of our DNA at Ecofin. As I mentioned again, ecology and finance, over the past 30 years, we spend the bulk of our time analyzing particularly the E of ESG. We are environmental specialists. So we want to make sure that our strategies actually deliver some progress and decarbonization and electrification, which are two structural trends we think in the energy transition. What I would say, though, is that we are not an impact focused portfolio manager in the case of this trust. This is not an impact strategy. Thank you for showing this table, James. Yes, as you can see, the outcome of the portfolio delivers actually a cleaner portfolio than the sector and the economy in general. So, but we are much more interested in EGL in analyzing the direction of travel. And that flexibility, rather than having ex ante filtering criteria, that flexibility in getting exposure to carbon intensive companies allows us to invest in those companies which decarbonize the fastest and get exposure to stronger growth and on-sale returns. That's how we invested in a company like Drax at a time when it was still largely exposed to coal and now has almost 0% exposure to coal. That's how we invested at the very early stage into RWE, Germany, just as they swapped some assets with E.ON at the time and became very much a clean power generator as opposed to a coal-fired power generator before. So we are interested in the direction of travel. We use ESG as an analytical tool, not as an exclusion criteria. Sorry, long answer, James, but trying to
good one.
Explain how we use it. Yeah.
Just
engagement. You asked me about engagement as well.
Oh, yes, exactly.
Yeah. So we are not activists, to make it straight for the record, but we do express views, and we've done it recently with a couple of companies. In our top 10, you may have noticed that we have an exposure to an Italian company called ENAV. Maybe a lot of you are not familiar with ENAV. ENAV is the air traffic controller with a monopoly in the Italian air market. So we find it a very attractive regulated business model. And the management of ENAV, which changed last year, started to talk about diversification, and looking for acquisitions in LATAM and non-regulated businesses. We expressed the view that these guys should very much focus on the core business, and this is what they've actually clarified a few weeks ago. And the stock, which suffered, re-rated very significantly. But maybe more to your point, we wrote to, for example, to Pennon last year, when we got very concerned to see how exposed they appeared to be to the water sewage scandal in the UK and the UK coasts. So we expressed our concern about it and the necessity for those companies to disclose as much transparency as possible on those pollution matters. So that does count. And again, we go back to our environmental hat in here. So we are not activists, but we express views for sure. And we vote at every single AGM of the companies we invest in.
Great, thank you. So obviously, in the investment companies sector, we've seen the derating that's happened across the whole of the renewable sector, and also the infrastructure sector too, is maybe not to quite the same extent, but still quite. Are those valuations now cheaper than those in the sort of companies that aren't classified as investment companies, so equivalent kind of things?
Cheaper than in what, James? Maybe, sorry, just to make sure I understand your question. Yeah,
it's like a Bluefield soda cheaper than another soda company that isn't classified as an investment company.
We think we really see an anomaly in the valuation of the listed infrastructure world, that's for sure. And the companies we have in our portfolio are, yes, cheaper than average. We're cheaper than average. We're cheaper than the private equivalents, but also, obviously, we are interested in those which we believe trade at very much on fair valuations for wrong reasons. Even between US and Europe, you see in US, utilities typically trade on between, say, 17 and 25 times earnings. Well, in Europe, you still have integrated utilities. Integrated is a very difficult model in the view of a lot of investors, difficult to value. And a lot of the large renewable developers are actually integrated utilities, which trade at 8 to 10 times PE. And examples of Enel in Italy, one of the largest wind developers in the world, trades at about 8 or 9 times. Engie, the French, also less than 10 times. So there's a massive discrepancy depending on the business model of the listed entity. So it's not a very efficient market as it stands, I believe, particularly in renewables.
Yeah, thank you. I agree with that. There's a question here that it's interesting. So is the infrastructure industry more liable to volatility due to geopolitical tensions than other industries?
Yes, it can work both ways. Political intervention, I would say, historically has been perceived as a headwind. With the debate about the decarbonization of the planet, we see it now as a very much a tailwind factor. Look at what happened with the vote of the IRA reform in the US. This is massive. This is about $600 billion to invest in infrastructure for actually pretty much the decarbonization of the US economy. We have similar deals with the EU or with the UK when we see programs for carbon capture. So, in fact, the political commitment means that now political intervention is more a positive factor from our point of view and very supportive of the returns. Because if returns get affected or overly hit by regulators, investment is just not going to happen. And so I think at the moment, we'll see whether the US elections coming up can dramatically change the picture. We don't think so, but obviously it's a perceived risk. But in general, we see political intervention as now a tailwind rather than a headwind, and that's a pretty new factor in the space. CapEx needs to happen.
Thank you. Obviously, your discount's wider than probably should be. What do you think the factors are that have contributed to that, and how do you think it's going to narrow?
Yeah, we find it quite unfair because, as you can see, portfolio is transparent. So when you have a listed universe which gets hit by the market, and then you have a discount, there's a bit of a double whammy. Up until mid-2023, the trust was trading pretty much in line with the NAV, or in some quite regularly at a slight premium, which allowed us to grow the trust in an enhancing manner, obviously, for its shareholders. And the discount widened dramatically over the past 12 months, and at some point reached almost 20%, some couple of months ago. Very unfair from our perspective. Our board has been quite proactive in launching some selective buybacks. The discount is now around 9–10%, so it's narrowed again. But it's a difficult one that you're asking me, obviously, James. What we see is that the whole space of infrastructure, again, has been derated. The market has very much focused on tech segments of the economy over the past 12 months, as opposed to long duration models. Interest rates have been a very negative factor for this. But we believe, and we very much have the conviction that this is a temporary phenomenon because of the long-term value that we see underlying in the fundamentals of those companies. And again, private equity investors typically are ready to pay premiums for that rather than discounts.
I mean, obviously that attracts the attention of discount players, and there's a question here about Saba. So they had a 5% stake, but I think they've already gone, so it's already fallen below 5%. Is that true?
There's been a press release announcing that they passed the 5% threshold downwards. The press release was released actually last week. Yes.
Yeah. I mean, is that something that will you be talking to them?
not me personally. I mean, they are a shareholder, and anything that can contribute to reducing the discount, we see it as favorably, I would say. The fact that they're paying attention to the quality of our portfolio, we're happy with that. So, frankly, and again, we've seen an interesting move in our discount over the past few weeks, moving from 17 to less than 10%. And we just hope this continues. And we see our strategy, given its long-term track record and delivery in line with what we had committed to, as a strategy which deserves to trade very much in line with its NAV. And why not at a premium, which we've seen in the past. So that's actually the delivery of performance is obviously the best way to convince discount players that there's only short-term trades to play in there. That's all I could say, but it's very hard to comment further.
Yeah, that is pretty unfair to ask you. It's more of a board question. But anyway, it does feel to me like they and a number of other people are just taking advantage of the fact that these share prices are too cheap, and good luck to them, really. So thank you very much for your time today. That's been really useful. We've covered a lot of ground.
Thank you, James.
As usual, we'll get you back on again in about a year. But thank you for today.
With pleasure. Thank you very much. Thank you, James.
So next week we will be back and talking to Ken Wotton, the manager of Strategic Equity Capital. And then we have now confirmed Gulf Investment Fund for the week after, 3rd of May, but also we have Andrew Petty on as well. And then, as we said before, we've got a full lineup all the way through now. So have a great weekend, and I will see you next Friday. Thank you very much.